idea of the fact that we already know there's buyers above us or sellers below us to trade back towards. So when we add all those asymmetrical edges, and then I say to you guys, for example, the trade we just talked about to Tim, and that gold trade just here, sorry, that oil trade just here, how many edges did you have on that oil trade, Tim? How many edges? Well, we can tick them off, can't we? We had a big surge in the limit order book. We had heavy delta selling coming in, but it was getting trapped, wasn't it? So we had the selling deltas coming in, so we had to be careful with that. So we got the block trade. So that's another delta we had. Traded volume. Yep, we got a surge in traded volume. We've already identified the traded volume candle, of course. We've already identified that on our trading view charts. So we got traded volume stepping up significantly. Was it into a level for a stop run? Yes, it was. It was into that prior swing low here for that stop run. Did it create alpha from that spike lower? Did it? Yeah, it created alpha when it spiked lower, didn't it? We just identified that when the price spiked lower here, it created a little bit of alpha on the spike. So when you look at that little spike there, you can see that it created alpha. Did it create a back holder? Well, that's kind of difficult because it doesn't really go through the level by much. You know, I mean, if I was to draw a trend line against the previous kind of significant low price, you would have drawn a trend line like looked a little bit like that. So I suppose it created a back holder, but it's not exactly a significant back holder. But yes, it created a back holder kind of narrative there. Was there a Voltic? I don't have Voltic on this chart, so I don't know what the answer to that question is. Was it structural? Did we see that there was buyers above the market, for example? We can see buyers above the market here. So when I look at how many edges you had on that oil trade at the bottom edge, when I look at how many edges we had to buy that trade there, it was enormous. Every single piece of information we had was valid for a scalp buy trade into that oil price for $100 a contract. And there was enough volume to get more than one contract in that trade. There was, perhaps you could have got about a 5, 6, 7 lot onto that trade, possibly even a 10 lot onto that trade, which might have been able to get you a substantial amount of profit out of that trade, right? You've just seen another example right there on this exact same bottom edge, another exact same trade right there, look. Another surge in volume into another stop run, into another bottom edge just there. You see it's also improved the crack spread again when we're looking at that trade there. We've been talking about this all morning, about this improvement. Well, there's another scalp buy trade. The limit order book was still bullish. The limit order book was still bullish. You got another big block trade. You got another reversal to lean against, and that reversal to lean against was at a price of 61. It was at a price of 61, so your buy trade could have come in at 61 to lean against that block volume right there, right on the pink line. And what happened? And that's what happened. The price went straight up to 66, 67, 68, nearly 68. It's crazy for an easy trade, isn't it? Absolutely crazy. Look, I guess obviously getting a lot of news out from earnings and various other things kicking off in the background. So it's been predominantly centered around some of the stock stories. There's not been an awful lot. There's not been an awful lot of additional pieces of information that we need to pay attention to. German CPI numbers came in a little bit heavier at 0.8% against an expectation of 0.4%. And that's obviously something that started to show up there. We've got MasterCard earnings coming out pre-market there at 1.64 earnings per share against an expectation of 1.51 and revenue of 4.1 billion against 4 billion expectancy. It's not had any market reaction yet, but MasterCard obviously quite a major a major player in terms of stocks. So yeah, not an awful lot for you to get started with this morning, but at least, as I said, something to pay attention to. We've been talking a little bit about scalping, some of the very short-term ideas, some of the very short-term thoughts. That scalp buy trade at 61's just gone to 71, so $100 on the second scalp trade as well, and a huge outcome, again. So another very nice, very nice trade. Yeah, well, remember we gave out GME as a cat trade a while ago, Paul, a few days ago. So, you know, if anybody wanted to buy into it, they had the chance to buy into it anyway. So it's up to anybody if they want to use the information that we provide. We had the GME trade at $260 a share. Remember, $260 a share on the 27th. So you could have bought against that that big wholesale price on a full 50 pullback. Well, why don't you take a subscription to Reddit, Jack? That seems to be a very valuable piece of information right there. When they come up with another one, post it in the room so that we can see it. The difference is we post them in advance. You know, we post these things in advance, and you know, there's a lot of these types of trades that you can look back on and you can say, well, how many did turn out good and how many did turn out bad? Those types of ideas. That's the problem, isn't it? That's the problem with any analysis. I mean, I could post a couple of brilliant screenshots into the room of some of the shares that we've taken that have gone from, for example, this was actually a class I wanted to touch on very simply, because a lot of people will see these things and think, my God, these guys are brilliant, just because they've posted one stock, for example, that kicks off massively. We post stocks that kick off massively every single day of the week. Every single day of the week, we post stocks that kick off massively. Look at this stock from December last year. Look at this stock here, JAGX. We posted this stock when it was trading at 50 cents, 60 cents. It traded a high price of $4.40. Pretty good trade, right? So you can see that when you're looking at these, you can start to see that over a period, some of these trades can make incredible gains. Incredible gains. There was another stock. Take a look at this stock here. This was AMTX. We posted this stock at around about $2.50. It traded nearly $11 a few weeks later. So this was a stock on the 22nd of December. By the time we hit into the 20th of January, it went from $2 a share to $12 a share. It's one of those types of things that, you know, this is why people go bust in the retail space. Because if somebody buys that stock at $3, do you think they knew it was going to go up to $400? Of course they fecking didn't know it was going to go up to $400, correct? And if they thought it was going to go up to $400, did the other 1,000 stocks that they also thought were going to go up to $400, did they all go bust? Did they end up going anywhere? The answer is no. So what happens is you get this, what is called a survivorship bias coming into those types of things. And somebody says, this young lad had this stock at 5 cents. This young lad had Bitcoin at £2. Does that mean that they're geniuses? Of course it doesn't mean they're geniuses. It just means they got lucky, and it's a survivorship bias that's resulted in that one person making an absolute killing on the trade. Survivorship bias. And you've got to watch for that, because it's a very seductive thing that somebody comes out. It's a very seductive thing that somebody comes out following a big move on something, be it Bitcoin or be it a stock, be it anything else. That somebody comes out and says, look how much money I made. And they did a study of, remember we talked about this before, Kim. There was quite a large Wall Street study made of hot new managers, hot new tipsters, hot new whatevers. And they looked at the guys that had made a fortune on a stock. They'd made a fortune on a particular stock pick, and they became famous because of that stock pick. And something like 80% of them were bankrupt the following year because they started to believe their own bullshit. They started to believe their own bullshit, that they actually did something that nobody else was capable of. And therefore they had some secret powers to success in the market, where actually what happened was they got lucky and they rode their luck well. They survived, but they became famous because they survived, not because they were good. See the difference? Being good means that you're consistently winning day in, day out, day in, day out, day in, day out. A classic example of this is somebody that won the national lottery, and they won a big prize once and they won a small prize a second time. And they actually started to sell courses on how to win the national lottery. Do you think that's even feasible? They started to sell courses on how they won the national lottery. And people bought these courses, Andy. You might think it's funny, but people bought these courses for £500 each. Because obviously they showed the ticket, right? They were able to show their ticket. They were able to show their prize winnings and say, well, I've won it twice. I must be really good. And obviously they've never won it since then. And anybody bought their course has never made a penny out of it. So you've got to remember that, real long-term success isn't catching a lucky break. It's being able to make 5 ticks here and 5 ticks there. It's being able to make a winning trade there or a winning trade there. If I compounded, for example, if I was continuing to compound a $1 stake since the beginning of last year, a $1 stake based on the red zone, green zones, I would hazard a guess, based on the red zone, green zones, I would hazard a guess that $1 stake would be worth billions at this present moment. Not millions. I'd hazard a guess, Kim, that if you were able to compound it against the red zone, green zones over the course of over a year, I think it would be worth billions of dollars. You can't have a $1 stake, of course, you've got to buy a contract. But the point is that that's a consistent track record of accumulation that massively outplays somebody like somebody like a one-off trade that makes a lot of sense, and that's what you've got to always try and remember is, you've got to just be that consistency. That's what brings you guys success. It's not the home run, and this is why it's dangerous when you see these headlines. This is what I was getting across, or trying to get across to Jack, is that when you see these headlines, it becomes very seductive for retail traders to buy into that storyline. It's like buyers of Bitcoin coming in at $40,000 or $20,000 as the last time. It hits the news when it's $20,000 and everybody buys into it at that stage. And the price then drops to $3,000. Bitcoin hits the news when it's at $40,000 and it drops to $30,000. The worst time to buy is when everybody's bought it at that stage. The worst time to bid into these ideas is when everybody has bought into those storylines. So one of the things you've always got to remember is that you've got to just be that consistent idea. You've got to be constantly looking at these as short-term, quick grabs, quick profits, quick bits of money here, quick bits of money there. It's just about finding a little piece of information that makes a little bit of sense. Just a just a tiny bit of sense. You're not looking for anything significant. You're just looking for that little bit of an edge. And if you repeat that edge time and time again, you're going to make some massive gains. And that's what you've got to try and think about, guys, is those massive gain opportunities over time. Welcome in, by the way, guys. Welcome in.